evening, everyone, and welcome to another episode of Quick Take. Today we are looking at Appen Ltd. So this one is actually a recommendation from one of my very first viewers, Alex, and this one is for you, buddy. Hello. Yes, I don't actually know about this one until today. I've read up a little bit about it before I did this video, so I have a little bit more to talk about and my view on this, and I think I can offer some insight because I am in the IT industry as well as the pharmacy industry. I've transitioned from pharmacy to IT, and I did a project with my university on artificial intelligence and machine learning, focusing on recommendation system. So me aside, let's talk about the company. All right, so Appen. So what it is from the description here is that it provides data set, so human-annotated data set for machine learning and artificial intelligence systems. So what that means is that human-annotated is basically they have a whole bunch of, let's say, pictures or words or sentences or whatever, so the data set, and then they ask people to label it as, let's say, a picture of a dog, a picture of a cat, a picture of a dog and a cat. So that's human-annotated. So from the data set, then the machine learning algorithm can use that to actually predict other pictures. So the importance of a data set in machine learning cannot be underestimated, because the only way for an algorithm to be more and more effective is through learning. That's why it's called machine learning. So they slowly learn more about a certain topic, and if you feed it more data and better quality data, and in IT we have something called reroll, which means rubbish in, rubbish out. What that means is that they want these annotated data set to be properly, let's say a machine learning specialist wants these data sets to be properly and precisely labeled, so it just helps with the learning algorithm. So this is kind of like a supervised machine learning algorithm, but there's many ways to do it. There's unsupervised and stuff like that, and semi-supervised, but from what it sounds like, it caters for the supervised data set. But supervised learning, but it could also be used for unsupervised learning, because at the initial stages you still need to kind of guide the machine learning algorithm through the process, so then it kind of learn. So yes, so it has two operating segments. One is content relevance. So content relevance is used for search engines like Google, e-commerce website. Actually, a lot of big tech companies use content relevance. YouTube, Facebook, Twitter. Basically, you type in, let's say, cat. So the next thing you know, they're showing you posts of cats or relevance to cats or anything really. So it's a huge thing, and it's going to be a huge thing. It's just I think I said it in the previous video, is that companies that don't invest in AI or machine learning now, they won't be able to compete with those that do, right? And so it's almost like a must now. But there's other aspect that's the periphery of AI that's also important, because you can generate data very clean, very neat, but you don't have someone who understands the data. So that's where the CEO and those managers comes in. So they bring expertise and experience to those data set. You turn data into information, but then you bring experience in, and that becomes knowledge. So that's a very important thing. You have to turn all of this data into knowledge, something that is actionable. And as in the case of the company needs to know, like, how is this data set going to support its current strategy or don't support its current strategy, so then it can pivot. Very important. A quick story. Jeff Bezos, second richest man in the world now, not the richest. He been described as very data driven, and all over the work, all over the properties that he owns. AWS, very data driven, machine learning's in there, Amazon Prime, all of that. It's just whole chunks of data behind it. Even big trading firms. There's something called the Citadel in America, and the Citadel is one of the most quietest trading floor you will ever enter, because the people that are hired, they're not actually brokerage, or they don't do anything with the actual stock. All the stock are done through machine learning algorithm. The people are hired there, that statisticians, mathematicians, and software engineers. That's where they're hired. And you yourself can probably write your own AI algorithm to trade stock. I just haven't got the time or the full expertise to write a full blown AI with the algorithm to help me trade. But who knows, in the future, this could be the last video, and tomorrow I'll just head off and do that. My point is that content relevance is very relevant. See what I did there, to a lot of businesses, e-commerce businesses, and it's not even e-commerce, educational businesses, platforms like, let's say, universities that want to kind of look up scholarly papers. Then they need a really good search engine. Language resources such as annotated speech and natural language image data. So these are akin to kind of with the natural language processing. So you notice when I talk, I put in these little quirks. I'm not sure what's the word for it, but like e, so all of that. So it does. If you just write a program to kind of like speech to text, then it might miss some of these and maybe it insert in like an an or am, so it wouldn't make sense. But with AI, they can differentiate, especially if the speech is annotated. So then a person listening to it can say, right, here is a segment of speech, annotate all the little vocal ticks. I think that's what they're called. So that's something very interesting also. And if you I think Google presentation from a few years ago, they were presenting a personal assistant that can actually make a call to I think it was a hairdresser and actually have a full-on conversation. The person at the other end did not know that was an AI they were speaking to. It just has all those natural language, discrepancy and vocal tics. Let's just use that for now. And it's amazing. And then now you have, deep fakes technology, where basically you collect a whole bunch of images and then you can superimpose that on to another person face and body. And I'm not talking about just one image, I'm talking about a whole video segment. And it's been in the news a lot because of the pornography industry. A lot of the technologies are being used that can be used for the pornography industry are being used for the pornography industry, which brings me to a quick story again. The success of the VHS is actually owed to the pornography industry, because so Sony came out with the Betamax and they were trying to be all hoity-toity, what is the word? High and mighty about it. So Sony on the other end, just distributed as far and what, not Sony, I can't remember, Panasonic, I think. Anyway, so the VHS just, the manufacturer of VHS just wanted to get it out there, and it landed in the hands of people who wanted to make homemade porn, and it just disseminate from there. And and they actually, years ago when they first came out, there's actually two different versions of, let's say, a movie. One would be on Betamax, the other one would be on VHS. And because VHS was so, it casted a really wide net and make the technology so much cheaper. through licensing deals and stuff. It just makes it easier, more convenient, and more affordable, and more logical to own a VHS rather than Betamax. So the Betamax got phased out. The main thing of that story is that it's these kinds of things, like the deepfakes things, it's being widely used and adopted by a lot of different industries, and it's going to the future I see for this. Whether you think it's a bad thing to have AI or you think it's a good thing to have AI, technology technology is there. It's the people who uses the technology determines if it's a bad or good use of technology. The technology itself is neutral. Yeah, so just keep that in mind. So yes, I see a very big future for ML AI. So it's already one thing. The company's already positioned itself in a very early a growing industry, and a very early stage of the growing industry, I must say. It is accelerating, and I believe it's going to continue to accelerate into the foreseeable future. All right, so that's a whole bunch on the profile of the company. Very excited to talk about these kind of companies. Right, let's go to the ratios and have a look. Okay, while that is loading, I think my internet is not very good. Let's have a look at this. So at the moment, it's $23.30. Market capitalization, huge, 2.8 billion. It does pay a little bit of dividend. Nothing that with these kind of companies, you want to, like early stage company, young companies, you don't want to see it pay out dividend. You want to see it invest every bit of money it has into itself, into R&D, especially in the technology industry. You want to see that kind of like reinvestment. So I'm kind of glad that they don't pay dividend. If you look at Amazon actually doesn't pay any dividend. It's a huge multi-billion-dollar company. It's one of the most valuable companies in the world, and it pays no dividend because Jeff Bezos understands the importance of R&D. Research and development, and that's how he keeps an edge over his competitors. All right, P ratio 62, which is it's lower than industry. First of all, fantastic. Secondly, it's fine. It's what the value investor would say as expensive, but with some companies like these ones, the smaller ones, the IT one, you want to see a little bit of higher P ratio because you're expecting a tremendous amount of growth. Right, so quick ratio got nothing, current ratio got nothing, and I think that should be expected. Like early stage technology companies, they don't have a lot of cash. They actually have to go out and borrow money, because investors, let's say the founder of what's that company, SoftBank? Yeah, he's big on technology companies, and he just go crazy with evaluations. And one of the things about valuations for IT companies is that it's like insanely high. It's one of the reasons because of that guy. I can't remember his name. Something Mashimoto-san or something. Anyways, so my point is that when you see companies and you see, or when you're reading these financial and look at the quick ratio, you've got to put it in perspective. What is this company? What is the industry? What is the norm for this industry? And you got to put it in perspective. So look, I'm very excited about this company. So I'm saying, yeah, no, that's not it's not too bad. P ratio is lower than industry. Okie dokie, let's look at the cash flow statement. Cash flow gone up, that's fine. Operating, that's always a good thing to see. Operating cash flow goes up. Some cash receipt, that's fine. Investing, yeah, fantastic. So it's investing into itself. So expenditures and investing cash flow items. So we would want to ideally look at these ones. Financing. So it's gone up. Does mean it's borrowing money. Well, in this case, it's not borrowing money. It's actually paying back debt. Again, a good thing. And it's issuing stock. So it's raising capital through issuance of stock, which is fine. It's just, if it's a small company and it buys stock. So that's probably explain. So what we can do is have a look at when that happened and compare it to the chart, which I probably don't have time for this quick take video, but you know, I can always do. I'm coming up with a series called In Depth, where I analyze companies in depth. Hence these names of these playlists. All right, so net change in cash, double. Again, keep that in perspective. Net change in cash, that's positive. Doesn't always mean a good thing. We want to see where the cash is coming from. In this case, issuance of stock is fine because, you know, when you borrow money from the bank, then you owe the bank money, and then there's interest payable. But the good thing about interest is that tax deductible. So keep those things in mind. All right, let's have a look at the balance sheet of the company. Let's see what we have here. So balance sheet, yeah, it's going up. So current assets going up, cash is going up. Sorry, it's my Slack account. It keep popping. Excuse those noise. All right, so total assets, current assets, total assets gone up. And let's see, goodwill. So goodwill, again, that's like the reputation. You can look at it that way. Current liabilities is 128. So it just doesn't have enough cash to pay for the current, the short term. And, you know, there's a danger in that, you know, because if the creditors come and say, I want my money, then it does put itself into a little of a pickle there. So it is a little bit dangerous, but you know, you would hope that this company is going out and asking for a little bit more cash, or at least it can cover itself for the next 12 months. So you got a balance between that. So I'm after reading this, I'm still excited about this company, but not as excited as before, because it's a little bit dangerous to not have enough cash on hand. So current liabilities, yeah, look, what is that? That's it's like 50%. Only lasts half a year, son. So 75.27 divided by 128.8. Yeah, it's like half a year. So you ideally want to see this company getting a little bit more cash through operation, or even in the short term borrow some more money. Okay, total liabilities also gone up. Total net, long-term debt's gone down though, so that's not too bad. All right, I'm out of breath. So excited talk about it. I'm out of breath. So all right, let's have a look at the income statement. I'm surprised it hasn't come out with the 2020, and that's a little bit. You wonder what's going to happen. So that's going to factor in the plan that we're going to have. All right, total revenue's gone up. Fantastic. Let's go straight to net income. I always like to look at net income. Net income gone down a little bit. Not significant. To kind of say like, wow, it's huge. It's not that significant. So net income before tax, revenue's gone up definitely. So it's operating expenses also gone up. So you want to know why. Selling, research and development. Oh, doesn't. Okay, so doesn't do any research and development, or maybe too small to show on here. So that's unusual. So where is it? Selling and general, so admin stuff. Ooh, what happened there? So yeah, I really want to see the 2020. Can we see the quarterly then? If you don't, doesn't have. Okay, let's have a look at the quarterly. Okay, gone up, stay the same. Again, there's no research and development. Yeah, look, it's a little bit worrying to see the operating expenses gone up by double. But again, just keep in mind perspective is that maybe it's still expanding, so it's not always a bad thing, because I say this, it's a growing company. When it first started growing, it might not need as much marketing, and that could be, marketing is a whole bunch of money. So, and it's important to market also, because if the people don't know that you're out there, nobody's gonna buy from you, right? Word of mouth is great if you're starting small. You get one client, the next. But when you want a mass appeal, you gotta invest in marketing, and marketing do take a chunk out of your operation expense, your budget. So keep that in mind. So you want to find out why this particular operating expenses gone up. What worries me though is the nothing for research and development. A little bit scary because it's supposed to be in the IT industry, and like I said before, no R&D means store decline. So it's either R&D or S&D. Yeah, S&D is store and decline. All right, let's keep that in mind. Still excited, but not as excited as before. All right, let's have a look at the chart. So yes, I said I've looked at this chart before, just gets everything prepared. So you can see here, down here, that's the operating, that's the net income, and it's increased. I would say this is the same. It's $10 million. It's okay. I mean, $10 million is a lot for me and you, but for in the perspective, no, is it 10? No, it's 100,000 grand. That's even more of nothing. Yes. All right. So let's have a look at this. Fibonacci's up that point to that point, and we can see that it's actually landed at the let me see. Oop, this chart is wrong. Let me just flip this baby around and see what we have. Bah. Oakley dokley. Cool. All right, so the retracements show up to the 50% mark. So if you buy there, you lost 50% of your money. But retracement, it is at some sort of support. It's probably a little bit higher than its normal support. So what I would want to do is just probably watch it very closely, and find out what's going to happen. It might actually sink to this level. And you want to ask why it's sinking to that level. So from the look of it, though, these huge in institutionals sell right there, and right there. So like you kind of wonder where this is going. The market hasn't been that bad. Like it's, let's see, 2019, 2020. Here it is. So it's gone up in 2000. Here it is. Sorry, this is where. All right, here's where the Australian crash is, and it recovered, then come back down. So could be, people got excited and start buying, and then kind of retrace back. So not bad in terms of like the retracement. It's I can probably put in if I'm FOMOing out, I would put in $2,000. Right now, I'm actually very comfortable in putting $2,000 right now, and because what I think may happen is that it's gonna retreat even more. If it does retrace even more, even like at this point here at the $17 mark, then I can use another $2,000 to put in, and then that increases my number of shares, but at the same time reduces my buying price. So that's a strategy I use sometimes if I really believe in a company and I believe that it's being oversold. And talking about we'll talk about being oversold a little bit later. At the moment, it feels like it's the smaller players that are getting rid of their stock. Maybe they got scared, and we can have a look quickly at the high close of these ones. So what is that? Up here, pay attention up there. High, low, close. Yeah, 50 cents. So what's that? Up. Could be a turning point. There, but then you show here. But that point there, not really a turning point, right? Because that's not what the MACD is showing. Down here, I think down here seems like a turning point, but it's not really. But continue to go down. But the 12 and the 26 days moving average is actually getting closer and closer. That's why it's moving up. So it could be a turning point here. I'm not satisfied with that as a turning point, so I won't be jumping in just yet. Right here is a definite turning point. So you can see there's huge volumes here, right? It preceded by huge volumes, and it kept going up. So at the moment, I'm a little bit cautious in buying it now. But let's have a look at the RSI. So go to indicators. I got to save here, relative strength index. So this will tell me if it's oversold. We'll tell with air quotes. So it looks like it's saying that it's being oversold. That's another kind of like, right, so is it oversold or not? Well, if you trust your indicators, then it does look like it's being oversold. And let's have a look. Here, it just kind of touched the oversold. Too bad I can't put 3. Actually, I don't need a net income anymore, do I? Let's put the MACD on. MACD. No, it doesn't seem like it does. Damn it. All right. I think I'm going to get... I need a volume also. Maybe next time I'll get the account, but it's a little bit expensive. All right. So here it's kind of touch the oversold part, then continue up. There's a huge volume to support the upward movement though. The down here is saying it's oversold, but it can kind of continue downward. So it's this RSI is not fully reliable. Down here it's oversold, and it's the average the volume there is high, but it's not as high as it could be. But here is when it really spiked up and continue up, but then it went back down. If you bought it at that point, then by this time you'd be break even, and that's almost 2 years. Buy down here though. Hindsight is 2020. Right. Yes. So it looks like it's oversold. MACD say there's a reversal here, but there wasn't. But there was almost like a slight reversal. So, right. All in all, it's a company that in an industry that I'm very, very excited about. It's making money. Again, that's an exciting thing. A drop by 100 grand, not a bad thing, but you kind of wonder why it didn't make money. Even though it's retraced a huge amount, so it retraced by 50%. So you kind of wonder if it can regain the ground, because a drop of 50% needs a gain of at least 100%. So how much more can it go? How high can it go back up, and how much more can go back low down? So the plan here is to probably observe until something exciting happens. Kind of wonder why they haven't released their 2020 results. It's always something that you want to find out in net income. So maybe I'll put this on the fridge for now. That's what my friend always say. Put on the fridge, and kind of just wait and see. And probably do a little bit more investigation into the company and find out what it does, and stuff like that. Get rid of that. Get rid of this. So we'll wait and see. Wait for cues such as maybe a spike in volume. Like I said, the MACD saying like it's buy time. But I'm not convinced. I'm not convinced with that at all. So I would wait and find out just a little bit more, and just have a concrete idea why, one, it didn't make any money, two, why is it not developing in any R&D, or is it developing some at the moment but it's just not a huge amount? Why has the operating cost gone up? So these are questions you want to find out. Volume, you want a little, maybe tomorrow, like there's a surge in volume, but maybe a spike up, and maybe it's like, hey, what's going on here? So I'm not saying a spike in volume is definitive. I'm just saying that there must be a reason why institutional players are coming in, and you want to find out, is it on? Now do the front page test. If it's on the front page test, it might be a little bit too late. The other thing is, where is it in this growth cycle? So is it, where's base? Base here, rapid growth. And is it heading top? It could be. Then, or is it starting its decline phase? And can it skip the decline phase and then continue at least to base at least, and then start another phase 2? From what I know, from what I've read, the only kind of way to skip the decline phase is through continuous innovation and research and development. That's why it goes back to, I'm a little bit of weary that there's no money in the R&D section of the income statement. All right, well, I hope you guys find it useful. I hope, Alex, you found that useful. And if you like what you see, please give us a like, thumbs up. And none of these videos are meant to be financial advice. Seek advice from your financial advisor, blah, blah, blah. Anything you want to add, leave it in a comment. Anything you want to say, leave it in a comment. Any suggestion for analysis, leave it in a comment. Otherwise, have a great day, guys and girls, guys and gals, gals and guys, and anything everyone in between. And hope you have a great day trading and make a lot of money. Bye.